Hi, I'm Pattu from freefincal. Today, let's talk about something that every mutual fund sales guy says. They say the best way to build wealth is via mutual fund SIP, long term SIP. You gotta keep investing and so on. Does that actually work? Is there any proof that long term equity SIP investing actually works? So, we're gonna look at a 106-year-old analysis. We're gonna look at data over 106 years. So, obviously, it means it's not from India, it's the S&P 500 index. And what is the benchmark for saying that a long-term equity investment has worked? So there are two things here. One is the victory of the asset class, and the second is the victory of the investor. That is a win for the asset class and a win for the investor. Now, if the return from the investment, that is the return from the index or the return from the S&P 500 or the Sensex has bet the inflation, the consumer price inflation, the CPI inflation, then you can say that the asset class has won. But does it mean that the investor has won? Not quite. So let's get to that. So first we will look at 10-year rolling returns of the S&P 500. These are the red dots. This is in USD. There's no need for foreign exchange here because we are looking at a US citizen. And this is being compared with the 10-year average of the consumer price index. That's the blue dots. And you can see the red dots have generally been well above the blue dots. So this means that a long 10-year rolling SIP, that is the dollar cost averaging as they call it, in the S&P 500 has been able to beat inflation quite comfortably. Not all the time, but quite comfortably. When it has underperformed the inflation is during those recessional years, which are well known to everyone. But notice the spread in the returns. The returns can go anywhere from 0% to, it has gone to 20% plus to 25% or more than that even. So the fluctuation in the return is very large, but it's generally above inflation. So in terms of a win for the asset class, yes, the equity is the correct asset class to try and beat inflation over the long term. There's no problem there. Again, the same data over 15 years, and you can see that generally this also turns out to be okay, comfortable, but you can see huge cyclic changes in the returns, ups and downs, and you can actually see those cycles move up and down. Even though the US has gone from an emerging economy to a well-developed economy, even then you can still see those cyclic patterns in the returns. This is the same data for the Sensex price data. I have added 2% and shifted it up by 2% to include the dividends because I don't have total returns index data from 1979. Only price data is available. So this is the price data. You can see the data is the amount of history is very short. That's why you don't see all those cyclic things that you see, but you can see part of those arm of that partial arm of that cycle. And the green dots are the PPF interest rates, and the crosses are the 15-year average of the consumer price inflation in India. And Sensex has comfortably bet both of them. Notice that there is a big difference between PPF interest rate and the consumer price inflation, especially in the 90s. That's when the government was almost bankrupt. So I would say that the correct inflation rate to use for retirement would be the PPF interest rate. That would be the correct inflation, or not the consumer price index, at least for the case of India. So like I just said, the asset class has won. Definitely there's a reasonable chance of beating inflation over the long term using equity. So definitely the asset class has won, but that does not mean the investor has won. The reason is, suppose you let's say the 10-year average of the consumer price index for in the USA is 3%, and the S&P 500 has given a 10-year SIP return of 4%. That means you have got a real return. That is, it has bet inflation. So the asset class has won. However, the investor has to pay tax on this 4%. So that will bring it down to 3% or even less than 3%. So the investor may not have got a real return, and nobody will invest 100% in equity. That will be stupid, right? They'll have to have an asset allocation, and in that asset allocation, how much did they actually expect is another matter. If they expected 8% and got only 4%, that means they will be disappointed. They would fall short of their corpus. So this is the reason why you should distinguish between a win for the asset class and a win for the investor. Now when these advisors keep talking, they always keep talking about this behavior gap. They will say people are not investing continuously, there is volatility, they will run away, there is panic selling, etc., and that is known as behavior gap. In my opinion, yes, behavior gap is very important. Of course, advisors also suffer from behavior gap. That's a different matter. Behavior gap means difference between investor returns and investment in asset class returns. Asset class will give some return, but the investor always tends to get, because of poor management, lesser returns than that. That's called the behavior gap. But what I would suggest is to actually consider the expectation gap. That is, people expect 15%, 18% returns, or even 12% returns seems too high sometimes in equity, and they will get less than that and they will start crying. So that's called the expectation gap, where they expect more and get less. My argument is that behavior gap is important, but if we plan properly and reduce this expectation gap from day one, then we don't have to worry too much about the behavior gap. We don't have to worry about the emotions if we actually carefully plan. So the first thing is to have a low return expectation. Choose the same bhajan. I have been doing the same bhajan again and again, and people will say you are not providing solutions. I am providing the solution. The solution is to have a goal, have the correct asset allocation for that goal. I have calculators for all this. You have to reduce this asset allocation from day one. Plan for a reduction in this asset allocation from day one. Therefore, so that you, no matter what the returns, you can manage your goal and get a corpus close to what you want. That's why I keep saying first plan. Don't worry about emotions. People say, oh, you are talking all this when the market crashes, I will be only making decisions based on emotions. That is fine. I am not disagreeing with that. But first you plan. Worry about emotions later. Anyway, you are going to be emotional later on. When the going is good, properly plan and have a system in place where you are not letting your the fate of your money to luck. If you simply invest every month via SIP, then what you will get is simply luck. You can notice how much this is called timing luck. If you sometimes you may get that much high return, sometimes you get that much low return. So you can't just let your investments to luck, right? So that is where the planning comes. So the asset class is correct, but whether it is correct for you or not depends on how you have planned, how robustly you are able to carry out that plan with conviction. So that's all I have to say. If you have any questions, please leave them below. Bye bye.